This is a series of videos considering PLCs and the relationship with their share price and market capitalisation. So within this particular video, I'm going to be focused on what factors could boost the share price, making it rise and therefore causing market capitalisation to be higher. We'll delve into some extreme and unusual factors which cause share price to rise, but you have to remember share price, it would increase due to higher demand for the shares. So if there's high demand for the shares, there must be a reason. Is it due to market growth and the company potential? Is it to do with their turnover growth or profitability? Is it due to potential internal and external strategies the firm is proposing? Now, the first example we're going to look at is actually one of the biggest share price increases ever witnessed in a day, and it's based on an external strategy which was mergers and acquisitions. One example of a very successful day of market cap was when Volkswagen became the world's priciest firm. And that was just simply over the course of a single trading day. So it was only the biggest company in the world for one day, but in that day they had a market cap of $420 billion. So that was eclipsing the likes of Microsoft, PetroChina and Exxon. So what caused it?
Volkswagen shares jumped on its agreement to buy the remaining half of sports car maker Porsche. Completing the purchase at a cost of just under €4.5 billion ends a long saga. The protracted takeover struggle sparked high-profile family feuds and lawsuits from investors. Porsche's high level of sales means that it needs additional production capacity, which VW can provide.
Porsche had long courted Volkswagen, seen a takeover as a means to secure access to Volkswagen's manufacturing expertise, but they resisted an aggressive move via a hostile takeover. So in 2005, it bought 20% voting stake in Volkswagen. By 2007, it increased it to 30%, which actually passed the threshold where it would have to make a mandatory offer for the company. However, this was rejected. In 2008, it went up to 50%, and Porsche began to buy up voting shares from 2006 onwards in its takeover bid. So the takeover bid was slow, it was very calculated, and it was quite strategic. And what was alarming is that Porsche actually managed to do this very quietly without much media attention, and in fact they managed to buy up a large stake without disclosing it to the market due to their strategy, which was actually entirely legal as well. And they had 74% of the shares at the point where they actually released the information to the markets. And many investments during the time of the financial crisis actually invested in shorts. Now, what do I mean by short? It means they trade and bet on the market crashing, or in this case, the firm's share price falling. So when Porsche announced and released their stock holdings, it instantly started to skyrocket the share price, which went against the short market. So short holders wanted to sell them as fast as possible, but to do so, they had to unwind their bets. So as many of them had borrowed Volkswagen shares in the hope of buying them back at lower prices once obviously the short was successful, it required each share to be bought back to close the trade. So there was a mad rush for them to do so to avoid losing money, and there was a panicked dash for the exit, which pushed up share price even further. And it pushed up the share price on those outstanding shares, which was they were the only ones left to try and buy and soak up that loss. So on Monday morning, Volkswagen's ordinary shares opened up at €348, which was up 66% from Friday's close, and it kept rising. So actually on that day, on Monday, they closed at €517, which was a 149% gain in one trading day. So it's my video based on why share price drops, and we had those examples of a failed merger causing share price to drop. If the merger is successful and expected to have great synergy, and what I mean by synergy is they're more successful as a collective than what they would have been on their own, and what often happens is the target company's share price rises. On the other hand though, in terms of the acquisition, when the acquiring company who's trying to buy out that company or acquire that company, they often have to pay a premium for the target company, which incurs quite a lot of debt. So actually that acquiring company's share price often drops. So you have to think about what perspective you're considering when looking at the share price. We're now going to look at a more recent example, and it's based on what's happening at the moment with COVID-19. So now you may imagine that the stock market is all doom and gloom, but actually there's some firms that are performing incredibly well during this pandemic and seeing their share price rise. Mr. Kipling maker Premier Foods, who also own Bistro and Bachelors, have seen a dramatic increase this year. Their share price actually rose 345% since the FTSE All Share hit the low point on March the 23rd when the UK went into lockdown. So that was measured to the market close on 16th of July. So even before COVID, their sales were up from previous years, but since lockdown, there's been a growing trend for home-cooked meals and baking. So there's been high demand for flour, cake mixes, gravy, pasta, and curry sauces. So about 1.6 million more people tried Bisto gravy for the first time during lockdown, and flour sales also doubled. So that prompted the company to switch to 24-hour production 7 days a week. So clearly their profitability massively increased, and that brings that attraction to buying shares within the company, because they can see that profitability is a signal for business growth, for high performance, and therefore the demand for these shares will push up the share price for Premier Foods. So there's even more companies that are doing well at this moment in time. So Adobe is another firm which has seen their share price rise, and this is related to their performance, especially in digital media. So they're delivering high levels of profitability even during the downturn in global economic growth. And one reason could be due to the need to stay at home. So needing the home software to perhaps work or study, and therefore Adobe offering such software has seen a rise in their sales. And because of that high level of profitability, again, investors are wanting those shares.
It's moving higher in the after hours. Josh Lipton has the details on this report. Hey, Josh.
So, Joe, heading into this report, stock got hit in today's trade, but it was still surging, rallying about 50% from its March lows. If you look at the report, just digging into the segments, digital media, that was up 18% to $2.23 billion. The other big segment there, digital experience, $826 million. Q3 guidance was light relative to expectations. I did check in, though, with Kirk Materne over at Evercore ISI. He covers the name. Kirk liked what he saw in this report. Said, listen, digital media ARR, annualized recurring revenue, $443 million. That was above expectations. That signal, Kirk says, that the core business is healthy here. Operating margins, he noted, expanding. So this is a company, he's arguing, that's delivering higher levels of profitability even during a downturn. Q3 guides, in his words, close enough to the street's estimates. Guidance will be read, he's arguing to us, as conservative. On the call, the company's CEO, Shantanu Narayan, saying the company's Q2 did coincide with what we hope, he says, was the peak of the pandemic. Nevertheless, Adobe drove strong performance across Creative Cloud, Document Cloud, and Experience. In times of uncertainty, he was arguing on the call, people are turning to Adobe's products to learn and work. In the digital experience segment, yes, the economic challenges, he said, enterprise customers are facing, weakness in small and medium-sized businesses did impact bookings, and as did, he noted, the decline in ad spending, but he called those short-term challenges. For more from the CEO, certainly turn in tonight to Mad Money, where he joins our own Jim Cramer. Guys, back to you.
All right, Josh, thanks. Grasso, you got this one?
Yeah, so the way I would trade this one is, first of all, Adobe's up 17% year to date. So to mute your exposure to any one software name, iShares has an ETF. It's IGV is the ticker symbol. The top two positions are Microsoft and Adobe, and then you get your Salesforce and your ServiceNow below that. This fund, this ETF, is up 19% year to date. So this has definitely benefited from the stay-at-home, shelter-in-place software needs that everyone in this world has needed. I think that for me, I bought this for my kids. I would buy this for myself. I think this is a better way to play it. You don't have to be tied to one stock like Adobe. Although I love Adobe, I think you have to mute your risk and own them all. I own Microsoft as well, but I think that you need a fund like this that helps you blanket that exposure, because this is where the growth is. The growth is not in energy stocks. The growth is not in value going forward. It's going to be right here at the center of
a Chinese firm called Alibaba, who's seen their share price rise, even if their market cap is quite low compared to its global rivals. However, it's seen massive growth, and therefore this share price rise will most likely be continuous on trend. They're the major player in China and yet to fully explore all Chinese geographic markets. So in China alone, they'll see high growth. Currently, they operate in 6 southern Eastern Asian countries, but if this increases, they may start to rival firms such as Amazon in the future, especially with recent plans to target Europe.
the Ant edge, competition in e-commerce in China has been fierce. You've got Pinduoduo, JD.com, just nipping on the Baba heels. Why is that?
Well, I mean, for a couple of reasons. First, the market is just ginormous, right? I mean, the other thing is Baba, up until very recently, had over 80% market share of e-commerce with some incredible margins, 40% EBITDA margins. And so over time, that just brings in a lot of competition, as it should be. What's interesting to us, and as you know, Baba hosted their day one of a 3-day analyst day last night, and they're still talking about growing the MAUs. They're still talking about growing the monetization of their user base, especially in some of these less penetrated areas where even Pinduoduo is trying to compete, like tier 3, 4, 5 cities where consumption is going up, internet penetration is going up, etc. So it's just very, very attractive market where you have dominant player in Alibaba, and so you have a lot of smaller competitor trying to get a piece of the action.
Right. So Yusuf, though, my point, though, is that if it has the insights of China's leading payments app, why doesn't Alibaba have more of an edge? How does it keep that, headway against some of the other e-commerce players? And also tell our viewers a little bit about this dynamic between Alibaba and Ant, especially because the IPO is coming up and it is likely to be the largest IPO ever.
Well, I think that Alibaba does have an edge in that by leveraging Ant, they have been able to continue to very successfully drive more monthly average users to the platform, more mobile user to the platform. I mean, as of last count, they have about 800 million users. That's larger than anybody out there. And even at 800, they're still adding 20 to 30 million users a quarter. That's in large part driven by Ant. The other thing is, over time, just like what you saw with PayPal and eBay, they have to part ways, right? And what we're seeing with Ant's IPO is a reflection of that. Alibaba is not the majority shareholder, only own 33%, but there is still an opportunity for them to continue to work closely through some arm's length agreements. So, Pinduoduo doesn't have that. I can't really think of any other large player that has that kind of a potential leverage.
Yusuf, is Alibaba the most undervalued cloud era conglomerate, or is it maybe the only fairly valued one? It just strikes me that we used to be talking about it in the same league with Google, with Amazon, but it's cheaper market cap wise than both of those. It's nowhere near $1 trillion, whereas Amazon's at $1.5 trillion in market cap. What's going on there?
I would argue that Baba, generally, not even just the cloud business, is one of the cheapest mega caps out there. For a company that's still growing, I mean, last quarter they put up a 34% growth rate. The quarter before that, which was in the middle of the pandemic, they still grew 22%. We'll see what they say tomorrow night if they provide any new guidance. But this is a business which I think is going to continue to grow somewhere in the 25% range for the next 5 years, right? At their range or at their size. That's incredible. Within that, you have cloud, which I think is a crown jewel there. Unfortunately, that business, because it's not U.S., because it's first and foremost focused on China and to a growing degree Southeast Asia, it doesn't have the type of visibility that Google Cloud gets, that Azure gets from Microsoft, or that certainly Amazon.
As more development takes place in China and more cities get better and more regular and easily accessible internet, Alibaba will continue to grow and their share price will also continue to rise. Also, it mentioned that it was a competitor to Amazon. And whilst Amazon operate in more countries and has the biggest market in the biggest market share in the biggest market, which is America, it can be argued that Alibaba is quite behind them. It will be interesting though to see their growth over the next 5 years and see the impact it'll have on their share price and their market cap. And considering Amazon is one of the highest market caps in e-commerce, and it's past the $1 trillion mark. $1 trillion mark. And you may ask, well, how much growth can Amazon achieve considering their current size? But recently, they've turned over a lot of revenue in advertising. So their ad revenue over the COVID crunch has seen a 40% boost to $3.9 billion. And this has just continued to strengthen their share price. Amazon has been able to generate turnover in lots of different fields with so many product offerings or service offerings, and they're disrupting a lot of different industries, from bricks and mortar in terms of physical stores with regards to the high street, to grocery offerings, food delivery, to even new markets such as India, and further robot offerings in terms of their own products. Their potential is huge. So the final example of why share price can grow relates to growth via market and product development and an increase in turnover.
Michael, it's good to have you. When we talk about advertising, do we mean quite simply advertising on Amazon.com?
Yeah, that's right. I would say about 90% of their advertising business right now is just sponsored products. And as we highlighted in our note, like, for, let's say, an advertiser like Procter & Gamble and Unilever, the analog I would say to investors is they pay for shelf space and placement at places like Walmart and Target, and this is just where a lot more of the world is transacting, is actually on Amazon. So it's an incredibly lucrative, very high margin business, which we think a lot of people underappreciate.
We know that Facebook and Google are the two leaders in the advertising business. Does Amazon have to take share from them? Are they taking it from, kind of bricks and mortar players, so to speak? How big can this business get, and why is it so valuable?
Well, what I think is $1 of advertising on Google is not exactly akin to $1 of advertising on Amazon. So out of our pivotal advertising insights, our survey work, it skews very high towards CPG on Amazon. And to me, it really is this ability to end up in the purchase path, increase the chance that you basically are going to get bought on Amazon. Now, where it's also super compelling for Amazon, and the way I framed for years, is for Amazon, it's the right ad business for Amazon, where people basically pay for placement on the site, the transaction stays on Amazon, Amazon basically keeps the purchase information, and the Procter & Gamble or Unilevers of the world basically have a better quantifiable set of results versus not knowing exactly how well those trade dollars may have actually performed on, the shelf space for Target or Walmart. So I don't really look at it as a shared
and that's exactly
gain
what
thing.
you liken this to. Yep, you're saying this is much like buying for shelf space on the internet. Listen, or in the grocery store, I absolutely experience this myself. It's almost hard to use Amazon anymore because it's all, kind of Amazon's choice being pushed at you and sponsored stuff everywhere. But that's life. We know that as these things get more sophisticated, they're packed with ads. So you're saying $93 billion of earnings power with advertising. The rest of the street thinks it's only about $69 billion worth. Does it make you uncomfortable to have such a high price target and valuation for Amazon, though, after it's already seen such strong performance? I mean, it does it just feel like maybe things are all going a little bit too well to be believed?
I really don't. I mean, I would say two things. I mean, one, I'm discounting back on, I think, a reasonable EBIT multiple for 24. So, my 2 cents is people are going to be valuing the stock in 2024, 2024 estimates in 23. So I think you have a chance of this being a $6,000 stock by then. So it's not that I think they're going to do 93 billion, but what I wanted to frame was people were not understanding the underlying EBIT contribution coming from advertising, A, and B, when everybody tries to do a sum of the parts model, which when companies give more disclosure is the natural Wall Street tendency, I don't really think it's how Amazon looks at advertising. It's really part of this flywheel of retail, prime, and advertising together. So that's really what we wanted to try to frame. We didn't take our EBIT numbers up that high. And look, we also highlighted in the note a few areas we think where conceivable large incremental investment areas could come. But the big ones that I look at, to be honest with you, are a move to same day from one day, which will drive revenues up. Mm-hmm. And I think that they ultimately will become more competitive with UPS and FedEx, which will also be expensive, but be another increasing TAM element to the story. So I actually don't think it's particularly expensive.